A sharp fall in global equities filters through with the mid-caps bearing the brunt. Uncertainty over the impact of hefty tariffs imposed by the US severely hurt sentiment. Metals and pharma are the biggest drags.
Pharma stocks are spooked by Donald Trump's comments saying tariffs will be imposed in the not-so-distant future on drug imports by America. He adds that these tariffs will be at levels not seen before.
HDFC Bank reports a strong show in the fourth quarter with its best growth in deposits and advances in over a year. Its deposit mix also improves quarter on quarter. The stock perks up.
Crude sees a sharp 6% drop overnight on fears a trade war will trim global growth. A move by OPEC Plus to speed up output expansion also dents prices. Crude sensitives swing to the news.
The White House clarifies that the tariff on India is 26% as presented by President Donald Trump and not 27% as was indicated in the annexure released by the White House.
The day of resilience, the day of breaking down, the day of outperformance. You can call the last 2 days in just these 3 words. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Hormas Vatakia. We come to you live from the CNBC-TV18 Motilal Oswal studio. Yesterday, we did see a bit of a decline, but there was an air of resilience in that decline. Overnight, we saw big cash on Wall Street. This morning, there was that news that came in on the pharmaceutical space. So that led to a further underperformance, or maybe coming to terms after the resilience that we saw yesterday. But today's decline, while it is high in an absolute term, it is still muted when you compare it to what all the other companies, or all the other countries rather, are doing as well. So we have a gash. There is not that air of resilience, but there is still outperformance. The broader markets have it a lot worse than what it was yesterday. So we have more stocks, way more stocks declining than the number of stocks which are advancing. Hi, Hormas.
Hi, Mangalam. 1,500 points on the mid-cap index, 3.5% shaved off on the small-cap index. Not looking good. At the same time, yesterday, the advanced decline was exactly the same image. The colors were flipped, but now the advanced decline firmly in favor of the losers in today's session. And it is these 3 export-focused names that are bearing the brunt, be it pharma, be it IT, or be it even the metal names who are declining despite the weakness in the US dollar. But the focus this morning has been on pharma. They were the ones that were the outperformers in yesterday's session, after there were no reciprocal tariffs mentioned on them. But US President Donald Trump has made his remarks at the Air Force One, speaking to reporters, saying that the pharma tariffs are under review and will be coming in at levels never seen before. Listening to what the president had to say.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
Right. What's the likely impact? What is the exposure for Indian companies? Let's go across to Winnie, who's brought out that list and the kind of problems that Indian pharmaceutical companies could face if tariffs would come soon. Winnie.
Latest update that has come in, where Trump made some comments coming in on the pharmaceutical space, saying that they will be announcing tariffs in the near future and not the distant future. And because of that, we're seeing pharma stocks are in focus today. Now, let's take a recap of what is currently charged by India on US. So India charges 10% tariff on pharma imports. US currently is not charging any import duty on the products for Indian category and Indian companies. So yes, as of now, the charge is nil. Now, what Trump wants to do, wants to charge them with a reciprocal tariff on this front. So it will be 10% or more than that. That's something that we're keeping an eye out on. What is the risk and who is at risk in terms of pharma companies? The main risk comes in for generic formulation players and CMO players in the pharma space, which is at the highest risk. The exposure of US generic companies is quite high to Indian companies to US generics is quite high, and that is why we will see that impact coming in. One-time hit in terms of EBITDA that we could see coming in, a negative impact would be around 9 to 12%. This is according to what we have a note coming in from Citi. Now, obviously, let's talk about the exposure. Gland Pharma has an exposure of 50%. So the impact on its EBITDA would be in the range of 8 to 10%. Aurobindo Pharma, 48% exposure to the US, and that would be in the range of 12 to 13%, I beg your pardon, in terms of the hit on the EBITDA front. Dr. Reddy's in the 10 to 12% range, 47% exposure there. Zydus, 46% exposure, so 8 to 10%. Lupin, Cipla, Sun Pharma and Torrent Pharma, a lesser exposure is what they have, and the impact on the EBITDA is lower. Now, why is that so? Because these companies have facilities in the US. Cipla, Dr. Reddy's, Lupin, Syngene, Piramal Pharma, Sai Life Sciences, all of these have exposure, means in terms of facilities that they have in the US, and that is why they're already set up in terms of the facility there. So maybe they could start importing from that facility. Instead of importing from India, you can sell from those facilities, which doesn't charge as much duty as what it would be charged from the Indian manufacturing facility if imported there. And that is why lesser impact on these companies on the EBITDA front as well.
Vinny, thanks a lot for that. At one point, most of these names were down and out. The Aurobindo Pharma was down 10%, but Laurus Labs now is the top loser on the Nifty 500, is down 8% now as we speak. Granules is the other underperformer today, 7% lower on that. Aurobindo has recovered slightly from the lows of the day, does not feature among the list of top losers on the Nifty 500, and this is despite the stock being down 6%, so it shows the kind of fall that most of the other names are currently witnessing on the broader markets. You'll talk about the metal names as well. Hindustan Copper is down 7%, Vedanta is down 7%, Nalco is down 7% as well. So metal stocks taking a bit of a battering in today's session. The Nifty Metal Index down at the lowest point of the day, 5% lower as we speak. We take a short break, but we get you more on the markets and specific stocks and continue our conversation on tariffs on the other side. Stay tuned. Welcome back. You're watching us here on Halftime Report. Now continuing our discussion on the tariffs, and there's this agreement that has come in between the ambassadors as well, the reciprocal tariffs that were put on India. Now, sources are telling CNBC-TV18 that the India-European Union trade ministers will hold talks again within a few days. Parikshit is joining in with more details on that. Parikshit, what are your sources telling you?
Well, the US reciprocal tariffs that have been imposed on all nations, including India and European Union, are definitely going to have a knock-off impact on the India-EU FTA talks. In fact, the talks are likely to get accelerated because of the global environment. Top-level sources tell us that Commerce Minister Piyush Goyal and EU Trade Commissioner Maros Sefcovic are going to hold talks very soon. There's going to be a phone conversation within the next few days, and there is very strong political determination to get an FTA done. Sources tell us that India is very keen, actually, to get an FTA done by the end of this year. The European Union is also watching out for India-US tariff talks very, very closely, and they are trying to see what kind of concessions India gives to the US government in terms of the agriculture sector, the dairy sector as well. Sources tell us that the European Union is not looking for any kind of quick fix, the way the US may be looking for India in terms of concessions, but they want a fully WTO-compliant FTA that serves the interests of the countries in the long term as well. Speaking to CNBC-TV18, the EU ambassador to India, Hervé Delphin, said that some progress has been made in talks. Talks have been positive, but they need a meaningful package which would serve the interests of both countries. They are hopeful of an early harvest by the end of the year and perhaps more meaningful progress on the larger FTA negotiations by the India-EU summit next year as well. And the EU, according to him, is very keen to increase cooperation in sectors like clean tech, semiconductors, defense and security as well. And they want a very broad-based agreement with India, and automobiles and components will definitely be one of the key pillars of this FTA.
All right, let's see how that goes. And from a consumption standpoint, we'll most definitely look at any sort of, reprieve coming in on imports of alcobebs from there. There is obviously the bigger benefit will be from the India-UK FTA, which will allow for Scotch to come by at favorable rates. But if India-EU FTA talks happen, will wine come by at favorable rates or not is something that we'll most definitely keep an eye out on. Speaking about stocks which are moving around, look at the consumption space. Pidilite is higher, obviously benefits from lower crude prices. Colgate's doing well, as is Berger Paints. But the one that's top of the pops right now is Marico. At the high point of today's trading session, came up with its fourth quarter update yesterday on the back of, having seen a big outperformance earlier itself. The stock did not react as much, but now it's moved higher to the high point of trade. Another stock which is doing well is HDFC Bank on the back of a good fourth quarter update, and that is reflected in the way the Nifty Bank's doing as well, almost 2% higher for HDFC Bank. Abhishek joins in. Abhishek.
Well, to begin with, sequentially one of the best deposit growth that you are seeing in last 4 quarters and one of the best loan growth that you are seeing in last 5 quarters. This was HDFC Bank's provisional business update do suggest. So deposit growth is at 14% YOY and about 5.9% sequentially. The CASA growth in absolute value is more than 8% quarter on quarter. So suggesting that the CASA ratio has also improved by almost 80 basis points sequentially. Now, this is heartening to see after a long time. Many lenders have been able to improve their CASA ratio. Now, advances growth is at 5.5% YOY, but 4% quarter on quarter. So the sequential growth is one of the highest that you are seeing in last 5 quarters, and this was led by the retail portfolio for them. Overall, the AUM growth is about 7.7% YOY and 3.3% sequentially. Calculation does show that the CD ratio or the credit deposit ratio has declined with reference to both YOY and quarter on quarter as well, and this is in line with the management guidance that they will be looking to lower the CD ratio in the coming quarters. Back to you.
And HDFC Bank is bucking the trend, ensuring that the Nifty is still holding on to losses of around 285 points and not falling further. But Abhishek, stay on because you have more details on the business update that Union Bank has shared.
Poor performance with respect to what they actually anticipated for FY25 and what actually they have delivered. So the growth rate continues to remain below industry levels for quite some time now, and they have missed the guidance as well. Deposit growth is at 7.2% YOY and about 7.7% sequentially. The guidance was about 9 to 11%, FY25 deposit growth over FY24. So domestic deposits are up 6% YOY and about 7.5% sequentially. The domestic CASA has grown by 3.9% YOY and about 7.8% sequentially, which suggests that the domestic CASA ratio has improved by 10 basis points quarter on quarter to 33.5%. Now, advances growth is at 8.6% YOY and about 3.6% sequentially. Their advances growth target for FY25 was about 13%, and they have massively missed over there. The domestic advances are up 8.3% YOY and 3.5% sequentially. The domestic retail loans, that's up 10.5% YOY and about 3.2% sequentially. Suggests credit deposit ratio, the calculation does show that it might have declined by a massive 300 basis point quarter on quarter, which suggests that the net interest margin could come under pressure in Q4 FY25 versus the number that they had reported in Q3 FY25. Back to you.
All right, Abhishek, thanks a lot for that. That's about Union Bank, down about 5%. Mazagon Dock is the other stock which is under pressure after the government has decided to sell almost 5% stake in the company. Upasna joins in to tell us more. Upasna, right from the word go, the stock has been lower because of increased supply and the price at which it was made, the supply was made.
That's correct, Mangalam. Now, let us look at the few of the OFS details that the company is given. Now, the government will sell up to 5% of its stake in the company. And mind you that the government currently holds nearly about 85% of the stake in the company. Now, this OFS includes a base size of 2.8% and a green shoe option of 2%. And OFS opens for non-retail investors on 4th of April, that is today, and for retail on 7th of April. Now, if we look at the floor price of this offer, it stands at 2,525 per share, which is at a 8% discount to yesterday's closing, but stock has corrected quite a bit today in today's trading session, and the total size is 4,900 crore. Now, if we look at the near-term triggers for the company is qualified for supply of P-75 submarines, and the order opportunity is as high as 50,000 crores in this. Now, additionally, company has also indicated that it has pending orders worth 25,000 crores. Now, if we look at the order book of the company, it currently stands at 3,50,000. And according to Antique, this order book can swell up to 3 times larger post this order opportunity that the company is looking at. So this stock certainly remains in focus on back of this.
Pasna, thanks a lot for that. Now, even after that 4.8% stake, the government will still have an 80% stake, which is well above the minimum shareholding norm. So that risk of further supply will still remain as an overhang on the stock. 7% lower on Masgaon Dock, 25.50 now, nearing towards its floor price of the OFS, which is 25.25. Some flashes on your screen as well. Emcure Pharma's European arm will acquire UK-based Manx product portfolio now for around £20 million is what the flash is. The stock too, in line with other pharma names, is also down around about 3.5%. But one of the other underperformers in today's session from the broader markets is Bharat Forge, and that's after Morgan Stanley has downgraded the stock and has also cut its price target. Sudarshan is here with more on this and its rationale. Sudarshan.
So Morgan Stanley has cut its stance to equal weight from overweight, and target is cut to rupees 1167 or 1170 from its earlier target of 1366 per share. That's a cut of almost, or say, more than 15%. Also, it has lowered EPS estimates for FY26 by 15% and FY27 by 11%. Now, giving the reasons, MS says this estimated slowdown in the US and the tariff issue could offset the gain by non-auto business and defense. Also, US auto and non-auto could face challenges on both the fronts, that on growth as well as the margin. And US truck, which forms nearly 99% of its standalone revenue, is already facing challenges. You could have seen the North America Class 8 truck orders even for the month of March. The orders had come in at a 7-month low. And on the tariff issue, it says 25 to 27% tariff on auto and non-auto products can impact the margin by 200 basis points in the near term. And as far as the valuation is concerned, MS believes that valuation at current levels looks full. And one thing that is management has been talking about the resolution of overseas subsidiary. On this front also, MS believes that it can be further delayed. So considering all these factors, it has downgraded the stock.
All right, so Arshan, thanks a lot for that. So those are a bunch of factors why Bharat Forge is down about 7%. We take a short break. On the other side, Manish Athiramani of Deen Dayal Investments will join in with some trading strategies. Manish has been calling the Nifty right quite a few times in the past. So let's get in his verdict after the decline that we've seen right now. Welcome back. Let's look at the setup from the F&O standpoint. The Nifty just under that 23,000 mark. The market's under a bit of pressure, no two ways about that, especially if you look at the broader market. So if you look at the Nifty, it's down about 1.16%, supported by a couple of indices we'll talk about. But the mid-cap index, that's where majority of the pressure is. It outperformed in yesterday's trading session, now firm underperformer. Let's look at sectors and how they are moving. All the export-facing sectors, Nifty Metal, Nifty Pharma, Nifty IT, down 3 to 5%, and that's putting a lid on the gains. All the domestic-facing sectors, you have the Nifty FMCG index, the financials, and the Nifty Bank mildly in the green. So the ones which are impacted are seeing a bigger gash. The ones who are relatively immune are seeing a smaller gain. So that's the tone and texture of the market. The Nifty, after having fallen, is very close to the 20-day moving average. Today, for most part of the day, it was under the 20-day moving average. Now it's recovered close to the 20-day moving average. It's exactly where we are, 22,986, but below the 50-day moving average. Can it close above 23,000 today or not is the big question, or will it close below the 20-day moving average? And the active Nifty option suggests that for the next week, 23,100 looks like a bit of a supply zone because 23,000 call writers are fairly active. On the way up, 23,100 call writers also equally active. So between 23,100 and 23,150, you might see some supply getting activated. But at lower levels, there is purchase at 22,900, and that's reflective in the kind of put writing that we've seen at 22,950 itself. That's the 22,950 call. 22,950 put comes up for you. That's seen some writing as well. A lot of shorts added on Bharat Forge and Lotus Labs, so keep an eye out on that one. And the first entrant in F&O ban for the April series could be Hindustan Copper. It's at 99% of the threshold level. Remember, stocks which crossed 95% enter the F&O ban. So Hindustan Copper may be the one that enters.
In the F&O ban for most parts of the series, right, is Hindustan Copper. So unsurprisingly becoming the first, or potentially being the first stock who can enter the F&O ban. But Manish Athiramani of Deen Dayal Investments is joining in now for a quick chart check. Manish, good afternoon. Thank you for joining in. Are you now in a no trade zone on the index, or would you still want to short it for further downside now that you are at that 20 DMA mark? And what are your stock recommendations this afternoon? Manish, I think you're on mute.
Good afternoon, Hormuz and Mangalam. Thank you so much for having me on the show. Well, I'll just take you back about 10 days when we were on the same show, when I had discussed the importance of 23,600 to 23,650 to be a major hurdle. While you might note that over the next 2-3 days thereafter, we did cross those levels. We went to 23.7, we went to 23.8 intraday. But when we closed, we were not able to decisively keep above 650 for more than 2 days at a stretch. That is the level that has acted as a major resistance. We are currently tinkering with the strong supports of 22,900 to be specific. A break of this will now currently disturb this recent up move that we have seen, and that can drive the index down all the way to 22,600 for starters. Having said that, the upside resistance is now capped at 23,650. Like you correctly said, I am in a no trade zone. I will start looking at shorts only at 22,900 breaks. While saying that, I'm now working with 2 shorts. The first one is on M&M, which is for a target of 24.35, stop loss of 27.80. The major concern with this stock is that there was a low of 30th of October, which has been broken. That level was 2669 to be precise. The last 10 to 15 days is also showing us an inclining volume with a fall, which is a negative sign. The second sell is on LNT, which is for a target of 3075, stop loss of 3500. Here too, it is a similar example where a low as far as 5th of June last year has been broken a couple of weeks back, which makes it vulnerable to retest those levels.
All right, so you're not in any trade zone right now, and if the Nifty breaks 22,900, you would go short. At what point do you go long?
The bare minimum, Mangalam, would be at least 23,650. So that is where we really go. Unless we don't get past those hurdles, it will be a resistance. While I'm still hoping that we should be getting buy signals, because I don't think we have broken down. The breaking down will only happen if 22,900 were to break.
And if that were to break, where would we go from? How much lower could the levels be?
I think for starters, we should look at 22,650 to 675. And thereafter, if we break those levels, then we will start revising those targets.
All right, closer to support levels below which there could be a 1,200 point downtick. But an upside right now looks unlikely until we cross the 600, 700 points from where we are right now. Thank you, Manish, for joining in and giving us your views on the indices. On the other side, we'll move away from the listed equity markets and individual stocks. Instead, we'll speak about, the world of private equity investing. More importantly, what the trends out there are. Sridhar Sankaraman of Multiples Alternate Asset Management joins in to discuss their strategy. Stay tuned for the next segment, which is Fund Race. Welcome back. You're watching us here on Halftime Report. We've been speaking about the equity markets through and through, but let's talk about our special segment, which is called Fund Race, where we're joined by Sridhar Sankaraman of Multiples Alternate Asset Management. Their private equity platform manages assets for almost $3 billion USD assets under management, with a couple of listed and a few unlisted investments as well. The most notable of them, I can see there is Dream11, there's Quantifi. You had investments in Delivery and IEX, which you've exited, and then there are Genie Mode, Montra Electric, Mo Engage, etc. as well. Sridhar, thank you so much for joining in. It's your second conversation with us. The first time you said that you back companies which have consumer love or brand love. Now that, since then to now, sentiment has changed. Things have, gotten a lot more cheaper or a lot more worse when it comes to growth, whichever way you cut it. What are the current challenges, opportunities, and the valuation environment? How are you looking at all of this from your lens?
Sure. Thanks, Mangalam, for having me here again. And I'm glad you have a great memory. See, for us, we are looking to take bets which are fairly long-term, right? 5, 6, 7-year bets. So the near-term doesn't change our long-term thesis in any significant way. I would say this is a great year for private equity because the last couple of years, capital markets was a real option for even companies which were not really ready for an IPO. But now the fact that things have corrected, I would see a lot more action on the private side. But to just quickly comment on the companies that you read out, the one common theme you will see in these companies that they are all new age businesses.
Yeah.
So as multiples, we took a very early call to invest in technology about 12 years ago. And our underlying theme was to say there'll be a lot of value created by new age businesses. If you think about the listed ones today, new economic businesses, there'll be about 20 of them which are listed with a market cap of 100 billion. That's 3.5% of our overall market cap. The way I see this, in the next 10 years, Mangalam, this will be 15 to 20% of market cap. So it's a large value to be created by tech businesses. And we were the first private equity fund to start investing in tech businesses 10 years ago, right? And that's something that we will continue to do. So we've invested maybe about $400 million in these companies, already taken out more than $1 billion. And this is only with exits from 3 of these companies, or 3 or 4 of these companies. So we see huge potential here. So these are the kind of companies that we would want to continue to go for.
Now, Sridhar, good afternoon. And you mentioned you take a 5 to 7 year opportunity, right? Where is that next 5 to 7 year opportunity? Because you hear a lot on the street that B is the next A or Y is the next X. Where is that opportunity, that next 2,000, 10,000, multiple crore opportunity that you are finding?
So 2-3 things are changing, right? One is, for the first time, we are seeing that consumers are becoming a lot more open to pay for subscription in India. I mean, we would hear this for the longest time that, people are not okay to pay for subscription, OTT. But if you look at the numbers of even people like Sony Live today on what is the kind of subscription revenue, something is changing. Quick commerce, we are all paying for delivery now. Something is changing. There is a lot of subscription-led businesses, which we see that naturally comes with affluence. Is one large opportunity. The second large opportunity is India B.
Got it.
And India B is not really, I'm not talking about Gorakhpur here, I'm also talking about Govandi, right? I mean, India B is also within our, within our big cities. And the products and services for India B will be different than products and services for India A. So that's, again, the next big, because they have just about started the discretionary consumption curve. So these are 2 large areas on the consumption side. In addition to this, on B2B as well, we are seeing opportunities where we are focusing our time on businesses which are not just buy and sell, but where can you add some value and create some serious moats. So we basically look at opportunities in 3 buckets. One is a new age businesses, which is about 10 investments that we've done and fairly successfully, which are tech led. And India being India, you will see a lot of these tech businesses keep allowing you to either create a new economic opportunity or challenge an existing opportunity. And if you're disrupting an existing market, your ability to grow faster than the market rate is much higher, which has clearly been our experience. The second bucket is classic growth. And the third bucket is buyout. So we are also seeing a lot of families were earlier not willing to sell their businesses. But in the last 2 years, we've evaluated about 20 buyout transactions. Just evaluated. The fact that so many deals even came to us tells you that something is changing. Families are a lot more open at 2 things. One, to professionalize management. And they believe that they need a change agent to do that. And a private equity fund can be that change agent. And the fact that the next generation is saying, Papa, I may not necessarily want to run this business. And so therefore, that's a big shift. The fact that shareholder and manager could be different, which has always been the case in the West, is now beginning to happen in India. So these are opportunities that we're seeing.
You spoke about exits and how you have a 5 to 7 year horizon, etc. Exits are now getting pushed down the road, a little more difficult. How are you navigating through that? Because I remember a lot of PEs who had lined up IPOs, and you said that not companies which were even ready for IPO were going IPOs. Gets a lot more difficult, right? And the other part that you spoke about, people paying for convenience. It has been shown so far that, the expected addressable market out there was not as big as the actual addressable market. So I'd written this thing called, we're not a TAM market, we're an ARM market. You have to look at the actual addressable market. So what are your thoughts on that and exits on the whole?
So I'll take the exit question first, Mangalam. There's a very vibrant P2P secondary market, which is now emerged. So if you look at it, it's not just capital markets as an exit window, but also private equity to private equity. And the amount of dry powder there is in this country is fairly substantial. So that, so I think there is a lot of action there as far as exits is concerned, and also strategic, right? In the sense, there are companies which are owned by private equity funds which are being purchased by strategic businesses. On the question on where is the TAM? It's a very valid question. So we are really looking at businesses where there is a particular serviceable addressable market. We are not taking bets where you have to believe that this will happen, but we already have indications. I'll just give you an example, right? When we invested in delivery, e-commerce was picking up. We looked at a lot of front-end e-com businesses. We could never build conviction on who will make money and how. That was our thesis on saying that the guy at the back who's really delivering the parcel wins irrespective of whoever is winning in the front. At that time, delivery was making money on a per parcel basis, even though overall, sort of they were in loss making. But the fact that the opportunity was visible, the macro was visible, is absolutely the call that you need to take. There has to be a path to profitability.
Sorry to cut you there.
Sure.
But you've made your money in delivery.
Yeah.
Shareholders haven't. If you look at it from the IPO price, the post-listing high to now, even now there is so much supply in the market, and fundamentals haven't kept pace with what other parts of the market have done. So that was what I wanted to understand. I mean, good on your fund that you guys exited with a fair amount of multiple, and when you speak about the listed space, the new age businesses turning from 3.5% to almost 10 to 15%, are there any opportunities in listed space which give you that sort of upside potential? Because from a retail investor standpoint, they can't get access to deals much before them being public.
Yeah. So Mangalam, as you know, we don't do public investments, so we are largely focused on the private side, and our return expectations are of course very different than that of a public market investment. Therefore, so I'll not be able to give you a prognosis on which are the stocks to track. But I would say that there is enough and more proof of concept of people having made money on tech-led businesses on the private side. It's just all about the stage that you invest in, and if you hold businesses for fairly long periods of time, I mean, kind of Zomato is a great case in point. They are now close to a $20 billion business, right? So I think three things that really matter is the founder agile? Because I think businesses are getting built and disrupted very quickly. The concept of build to last is something that is being challenged every day. Right. So you need to look at businesses which are very, very strong founders, very agile, markets with very strong profit pool and clear path to profitability. I think if there are these three fundamentals are in place, I don't see why the value will not get created over long periods of time.
Sridhar, just one final question. Is there, you spoke of opportunities, right? With the recent shift in market sentiment that you've seen over the last 6-7 months, have there been any asset that you were looking at earlier has now become more reasonable and you're eyeing those now?
Absolutely. So, as I speak, there are at least a couple of opportunities that we're looking at where expectations of both the founder and maybe incumbent investors have become a lot more realistic. The bid-ask spread has kind of reduced. So I'll give you an example. On the consumer side, the last 2 years, the number of deals that we looked at, the actual deals that got done, only a third of the deals actually got done. Okay. Because A, the growth did not come, and B, the bid-ask spread was very, very high. Right. I think that is something that I'm saying that could likely change in the next few quarters.
Any specific categories?
Wait and watch this space for more action, Mangalam.
All right, I will do that. And just off the cuff, you have investments in Dream 11, right?
We have exited that as well.
You exited that. How much did those ads cost? You're not going to tell us. All right, what we'll do is we'll take a short break on that note. On the other side, we'll focus on Trump tariffs' impact on IT sector and what brokerages are saying about that, because it's been the sector that has been on a rout over the last couple of trading sessions. Fair amount of value eroded out there. Keep an eye.
Welcome back. Still 280 points down on the index, and the broader markets too faring no better. The mid-cap index is still down around about 1,500 points. The small-cap index too has around about a 3.5% cut as we speak. A slight recovery from the mid-cap index, at least 1,350 points lower now. But the small-cap index still continuing to trade with losses of well over 3%. Stock that has sprung up among the list of losers is Samvardhana Motherson. That is now down 7%. At the lowest point of the day, and has sprung up among the top losers on the Nifty 500. So not good going there for Samvardhana Motherson at the lowest point. And there as well, Hindustan Copper, as Mangalam was just mentioning, may enter the F&O ban. So 7% lower there as well. And ONGC, of course, after that sharp fall in crude oil prices overnight, taking both ONGC and Oil India down. ONGC is down 7% and Oil India too is down a similar quantum. But as we were mentioning, the Indian IT sector has been the one that has been not directly or indirectly impacted by Trump's tariffs, but the risk of a slowdown or a recession in the US could have a near-term impact. Rima has collated what brokerages are saying on this. Rima.
Thanks so much for that. So let me start with Bernstein, and they say the near-term risk for IT emanates from a potential recession, which can delay IT spending and result in tightening budgets. In a worst-case scenario, they're saying we could see a deep global recession similar to the 2008 financial crisis, the global financial crisis. And back then, the major IT services firms saw a significant revenue decline. 6% quarter-on-quarter revenue decline for TCS in Q4 of calendar year 2008. Accenture's revenues fell by 13%. Not that Bernstein expects a GFC-like situation once again, but they do say the growth will get impacted. Growth is likely to remain flat in FY26, contrary to earlier expectations of some sort of a post-FY25 recovery. Given the market volatility, their preference lies with large-cap quality names. So Infosys is their top bet in the large-cap space, Coforge in the mid-cap space. The sectors that they are avoiding are the auto ER&D companies. So LTTS and Tata Elxsi, they're underweight. Now moving on to JP Morgan, and they're asking the critical question, when will IT bottom out? Now, they've identified the bear case scenario, which is basically no revenue growth for companies like Infy, HCL Tech in FY26 and no margin expansion. If that plays out, then we're talking about an EPS cut of 9 to 11%, leading to potential stock price declines of 7% for TCS, 6% for Infosys, and 14% for HCL Tech. Mid-caps could see an even steeper impact, so 13% of a stock price correction for Coforge and 25% for Persistent. So the question is that when do you buy? Not before earnings. The conservative guidance that these companies might give might push stock prices lower, and that could provide a better entry point. JP Morgan does suggest have a lighter IT positioning. They remain overweight on Infosys and some of the growth mid-cap growth companies. Now, Kotak is worried that this current uncertainty at the beginning of the year will delay spending and impact the June quarter. Now, the June quarter is important because it's seasonally strong, and that's what gives the IT companies strong growth for the full year. So, and once again, Kotak has cut the revenue and EPS estimates after cutting it just in March of 2025. So in 1 month, they've again lowered their revenue growth, baking in the US tariffs. They're saying there is a possibility that FY26 could be worse than FY25, and their estimates are up for you on your screen. We'll just get them up over here. Given the higher guidance, scrutiny on guidance, Kotak also goes on to say it may be prudent on the part of companies to defer their guidance until there is more certainty on the demand environment, or they could restrict the guidance to the next quarter where there is a higher degree of visibility. A recession, to their mind, means downside risks in stocks exist. If there is just a slowdown, not a recession, we could see reasonable upside. And finally, let me cap it with Macquarie, and on a good note, because they think the market reaction on Indian IT is overdone. Investors, if you have a long-term outlook, you could use this opportunity to add to positions in Indian IT. Back to you.
Right, Rima, thanks a lot for that. So that's about the IT space. With that, let's take a short break, come back on the other side. Commodities, that's the other thing that we are tracking today, and that's largely because of the big rout that we've seen in commodity prices ever since Trump tariffs were announced as well. So not just the IT, pharma, metal space, we have all the other commodities basket under pressure too. Manisha Gupta joins in with a gentleman from Swiss Asia Capital. Stay tuned for that. In an otherwise wobbly market, we have Interglobe Aviation, which has moved to the high point of trade, doing extremely well this afternoon. Well bid on account of higher volumes, better market share, and perhaps lower costs as well, as crude prices are lower. Speaking about crude, a lot of the other commodity prices are lower as well. We have Manisha in the studio with us. Manisha, take it away.
Well, thank you so much for that, and welcoming a very special guest. Jörg Kiener is MD and Chief Investment Officer at Swiss Asia Capital. Jörg, thank you so much for joining in here at CNBC India. Your first reaction really to tariffs and the way gold has performed, really. We've seen $100 of a range yesterday, and a lot of people would like to believe that gold is kind of underperformed given the uncertainty that we have, and the safe haven buying that the markets were anticipating didn't really happen.
I think the safe haven purchasing has been starting a long, long time ago. I think it started in the year 2000 and has accelerated actually constantly. And if you think the dispute about these upcoming tariffs have been going on now for quite some time. So we had already a big, big move going from the basically low 2000s into the 3000s now. So we already done a very good 30% move. The market still looks like it wants to go further. And I think with many people still having to meet Basel III requirement, particularly the US and UK banks, the pressure on the way up is still there.
Jörg, so what is your sense on where is gold heading now? Are we looking at some more correction before we start to run up? And how far do you see on the higher side gold prices really targeting?
Look, we are trading quite a bit above the moving averages. So let's say we could have a smackdown to 2.8, 2.9. That's all possible. I don't think we'll be staying there very long. I think that the trend will continue to go up and accelerate. And when I mean acceleration into July, I think you could easily see somewhere between 3, 5 and a few $100s above that for this year, and probably prices in the tune of $5,000 to $8,000 in the next couple of years.
Oh, wow. That's very, very bullish cues coming in for gold. Jörg, what's your sense on silver? Because that's lagged behind a bit. All-time highs are far away, but it's making it very hard to keep up with the kind of run-up that we've seen in gold. Would you say silver seems to be resembling more like metals right now rather than the precious metal?
I think what you have is a huge accumulation of silver, particularly into China, and we see people shorting the silver market through ETFs, which is basically been keeping prices down. So we have a real mismatch on the West versus East. We see as well huge spreads. So you could actually sell silver into China at $3 spread. So that tells you actually that we have backwardation in the system, and that silver should actually really perform very, very well indeed.
So Jörg, where do you see silver going forward then? Do you think there are buying opportunities coming in here, or there's more pressure that could be seen?
Look, I think in the low 30s is a great time to buy, and you want to be testing at least the $50 mark, which is basically would be a triple top in the short term, and then we'll see where we go thereafter. But I think that's about the trading range, $30 to $50 for probably the foreseeable future.
So Jörg, while you are quite bullish on gold and silver, how would you look at metals as a space? Because the two major economies, China and US, really seem to be trade warring right now. How is that going to impact the prices here?
I think what you start seeing is that you're going to get very different prices from country to country as we're moving from a global world to a decentralized world. So your pricing might be very different places. You see with this onshoring, which happened in the United States, a large capital investment cycle taking place again, next to the one we see in the BRIC countries. So the demand will certainly be there. So I don't have a problem with metals. I think if you look at copper, it's been highly volatile this year, but it looks like it's been breaking on the way up. Palladium, platinum, which are the other two PMGs, they've been disappointing. They've continued their correction on the way down. We'll see when they will turn. They are so small, it might not really that matter. So copper is only the other big metal in the room, which is really showing the sign that all metals are going to turn. If you look at iron ore, which is important from an economic activity, you're actually seeing that shipments into China are still continuing to be going at record pace, and that at a time where you have military buildup, which is high for steel production, I think that shows you as well that metals should actually be reasonably well supported.
Jörg, I also want your sense on the crude oil prices, because we've seen 6% decline overnight, 1% down as we speak, and the markets tend to tell us that another 6 to 8% of a decline or even more is not ruled out. How would that augur for the US shale producers then?
Look, let's say we go another $10 down because everybody's going to be afraid of shale production out of the United States. That's all possible, good and right. So that's a 10% risk on the downside. On the other side, we have a possible risk of further warfare in the Middle East and in Russia. And in case with the Straits of Hormuz going to close, then maybe your oil price will be $100 plus in no time, because there will be no shipment going through the Middle East. So your risk return metrics is from the upside downside actually doesn't favor that the downside has so much risk over time.
So what is your targets then, given the kind of scenario that we are in right now, where we're looking at OPEC and allies increasing production, the US inventory is going higher, tariffs impacting demand going forward? How do you see that impact on prices?
So it's not very positive for the producers from that point of view. So we're not really buying the equity in the energy space, but on the energy itself, I think if you look at energy prices, they can be so different. You can have onshore supply and production at costs, which in some countries is so low you can't compete. So I think you really have to figure out where you buy it. overall, I wouldn't be a massive buyer of energy right now. But if you are living in a specific country, you certainly should actually be looking at locking some of that in. Depending if you're a producer or not a producer, I think is probably one of the key issues.
Jörg, thank you so much for sparing time and joining us today this afternoon. Manisha, thank you for joining in as well. Will not be a buyer on energy at this price, but very bullish commentary coming in on gold prices, of course, and that has been the one that has been shining through and through. By the way, some sell-off has intensified on the index, though. 300 points down now on the Nifty. 22,950 is where we are, and 22,900 is the level that Manish Hatiramani was also talking about for further downside on the index, and IT is the one that has been bearing the brunt of this. Coforge is down another 6% today. Persistent is down another 5%. And Emphasis down another 5% as well. We take your leave on this edition of Halftime Report. Business lunch for the next 30 minutes.